In the final targets in focus of this eventful trading week, Dukascopy TV are delighted to welcome Ankita Dudani from RBS to discuss the drivers behind and what to expect from three of the major currency pairs. Welcome to Dukascopy TV, Ankita. Let's start with the trader's favourite, euro-dollar. There's been no shortage of market-moving events this week. Do you see the next few weeks being as turbulent? And if negativity continues, could we see it fall below 134?
Now, what's important here is that the core Eurozone is no longer perceived as a core. France, which is a AAA, the spread is widening sharply, and it's about a couple of basis points wider than its other AAA. So the question is, how is France a AAA when it's more than 200 basis point wider than Germany, Finland, or Netherlands, let's say? Our year-end forecast is 133, so that's below 134. And in terms on the other leg of euro-dollar, in terms of the U.S. economy, even though the spring slowdown, which was largely due to temporary factor, it took much longer than our initial expectation. But we still see that despite weak consumer confidence in the U.S., driven by the debates on debt ceiling, the S&P downgrade, and the Eurozone crisis, the recent indicators in the U.S. have been quite solid, and even the consumers are not so positive. The data is not showing, the real data is not proving so much, and we do expect the debate over the U.S. fiscal policy to re-emerge over the coming months. We've got the November 23rd deadline at the Joint Select Committee. So these are potential factors that can put downward pressure on the dollar. So even though we are structurally and fundamentally very bearish on the Eurozone, our euro-dollar forecast peaks it only gets as worse as 133, which is by year end, and then we look for some sort of an upside, but not to be confused with a positive outlook on the euro, but more of a negative outlook on the US fiscal side as well.
On to the euro-yen now. We would expect the European crisis to be the main driver of this pair, but has the Olympus scandal of hidden losses had any impact? And where do you see this pair heading in 1, 3 and 12 months?
I mean, I wouldn't say, I think as you said, like euro-yen or dollar-yen is pretty much driven completely by risk appetite, and I think there's a lot more going in the global scenario and how the Eurozone or the US economy and how these countries play out, rather than domestic factors to really focus on. So the authorities there are eager to prevent significant gains in the yen, and we think it's about what they get uncomfortable with is about mid-70s in dollar-yen, and but that said, there is a reluctance to try and push it too high because they still want to be in line with the G7 or G20 statements and don't want to be seen as devaluing their currency to simply stay competitive. I think what is clear that they're worried about the pace of the strength rather than an actual level. But that said, I think the level that we think has proved to be some sort of an indication is the 100-day moving average in dollar yen, which is currently very close to where we are right now, about 27.63. So that's something which market will keep an eye on. And in terms of euro yen, because of all the reasons we discussed earlier about the core countries and the periphery countries and all the political noise around the Eurozone, we have our euro yen forecast going to up to 100 over the next 3 months, and that's kind of what we saw as it's slightly hard to get euro yen well below 100. I mean, it's a psychological level.
Finally, on to the dollar CAD then. Has the US dollar been returning to its safe haven status recently, and what impact has the rising oil value had on the Canadian dollar, and where do you see this pair heading in the short, mid and long term?
Oil is an important driver, but more than that, what's been the focus recently is just risk appetite. And you've seen dollar CAD below parity at the beginning of November, and then it's sharply turned, and it's about two big figures above there, which is a function of not so much about oil price, but about what's happening in Greece, about what's happening in the Eurozone. So, like Aussie, like Kiwi, it's another commodity currency that's very sensitive to risk appetite. And if you pull the chart, even though oil has been quite strong, we're just shy of 100, and we're just shy of $100, which is like about good $25 higher than where we were early October. CAD has not strengthened as much as one would have hoped. It did strengthen in October, but then come November we've seen a reversal in Canadian dollar strength, and that's obviously got to do with how the how risk appetite is turning over the last 2-3 weeks. In terms of obviously, we need a lot of U.S. momentum for the Canadian economy, for the CAD or the Canadian economy to do well. It remains heavily reliant on the U.S. growth. It's 80% of Canadian growth, Canadian exports are destined for the U.S. economy. In terms of our forecast, we've got dollar CAD trading well below parity over the entire next 12 months. So we've got it at 98 by year end, and it stays around that level.
Thank you very much for joining Dukascopy TV, Ankita. Targets in Focus will return next week, so enjoy your weekend and goodbye.